Good afternoon. My name's Danielle, and I'm the VP of Options at Simpler Trading. And today I'm going to be walking through an example of what happens when you get assigned early on a short options contract. Now, I was trading Tesla this week for earnings, and one of my favorite things that I like to do surrounding earnings is selling premium. The reason why I like to do that is because when you have an earnings report coming up, you have a situation where you have a rise in implied volatility. Now, looking at this graph down below, what you're going to see is the earnings volatility and how it changes throughout the quarter. Now, you can see that it was at a low in the quarter after last quarter's earnings report and it proceeded to climb. It did dip a little bit around here, climbed again going into Q2 earnings. And after that, this volatility was crushed. Now, this is one reason why I like to sell premiums surrounding earnings reports, is because the idea is that you can, sell the options right before earnings here and then buy it back when it's cheaper the next day. Now, obviously, that also requires for you to set up the trade and execute it in a way as such that that will work. Now, in this situation, my trade did not work. I lost money. And not only did I lose money, I also got assigned on the options. So I thought that I would make a video for all of you to show you what it looks like when that happens. Now, I'm going to go through a couple different things here, but first of all, I'm going to explain, why I got into the trade. When you look at Tesla over earnings, this is a stock that moves quite a bit over earnings reports, right? You have up moves, you have down moves. And these little bubbles right here demonstrate what the moves have been over earnings. And then the stats up at the top explain what the stock has done over the course of the last 12 quarters. I look at pre earnings moves, I look at the moves over earnings, and I look at the moves post earnings. Now, typically with Tesla, because it is so volatile, I do this same trade every quarter. And when you look at the moves that Tesla has had, the trade will work generally about 9 out of 12 quarters. This is just one of the quarters that it did not work. So, what you need to do when you're setting up the trade, and that's probably better topic for another video. But basically, you look at the market maker expected move. Now, the market makers were pricing in about a $20 move on Tesla. So, what that means is that, if you sell the options when they're at the money and it moves less than $20, generally you can buy them back the next day for cheaper. Now, you'll notice, well, Danielle, it only moved $11. Shouldn't you have made money? Well, yes, I would have if I would have taken it off first thing in the morning, but I got a little greedy and I was trying to give it a little bit of time, and then the market just kind of rolled over. So I missed my exit. Now, what does it look like when that happens? Well, first of all, when I got into the trade, I had a pretty good risk to reward situation. That's also one main reason why I will get into these trades. So let's go ahead and look at what that looks like. All right, so here's a screenshot that I took when I was entering the trade. You can see that my max loss was $1,000. I usually position size these kinds of trades for 2.5% of my account or less. Generally, around 1% of my account is the risk that I take per trade. Now, you'll see that the max loss was $1,000 and the max profit was 2,900. Now, if you're looking at this, you can say, well, geez, you're risking one to make potentially three. That's exactly why I like to do these kind of trades, especially if, they're going to work 8 out of 12 quarters, 9 out of 12 quarters. You're going to take a quarter or three where you lose the money, ideally not the max. But most of the time, if it moves less than the expected move, you are in the green. So this is what it looks like when I set on the trade. Now, when I set up the trade. Now, you can see that there were some short strikes here. I had a short strike at the 295 and then I also had a short strike at the 295 here. So essentially what I did was I created an iron condor where I had sold the 295 calls and I also sold the 295 puts. Now, somebody wrote me on Twitter and said, like, oh, you're going to get killed, you're going to die, this kind of thing. Like, no, it's really not that dramatic because what you do is you're then buying another leg for protection. So I bought the 315 calls. These ones are the ones you sold. These ones are the one you sold. And then I bought the 275 puts. Now, you may ask, well, why would you do that? You do that in case you get assigned or in case the stock goes crazy like it did. So, what I did was I sold these options because I wanted to collect premium. Okay. This is the premium that I collected $14.52. Um, and that was per contract, so 2 contracts. So, it's about $2,900 that you're collecting, all right? The idea here was, sell it for 14, buy it back the next day for 7. When the market opened, I didn't, have my $7, so I thought, I'm gonna wait just a little bit, and it got away from me. So, the reason why you buy these outer layers is because what can happen is if you sell, these 295 puts, you can wake up to a situation where the stock has gotten crushed and suddenly you are short the 295 puts and now your stock is, down at 265 or down at 255 and you have just an incredible loss and you also have the very high likelihood that you are put the stock at the 295 price point. So you now are the lucky owner of Tesla shares at 295 when the thing is trading at 265. Not a situation you want, which is why you never sell options naked. Being naked can be great, not in the options market. So, um, when you're looking at that, definitely want to do it with protection. And you want to see, okay, so if you do that and you sell the options and you have protection, then what does that mean? Does that mean you're protected from assignment? Can you still be assigned early? Well, yes, my friends, you can still be assigned early. Now, when you look at what the trade was doing yesterday, today's Friday. And so today is what? Friday the 21st. When I look at what the trade was doing yesterday, okay, initially, right on the market open, this was like maybe 15 minutes after the market opened. I took this screenshot. I was losing, $240. The premium that I sold for 14.25 was then worth more than what I sold it for, 15.45. Um, so, not ideal situation, but not a bad loss either. Could have bought it back right at the open. Didn't. We already went over that. So then what ended up happening is as the stock price fell, I thought, well, we might see a bounce on Friday. So I'm going to hold it one more night and I'm going to see if I can take this thing off on Friday for better than max loss because yesterday I was at a max loss. I was losing $1,000. There wasn't really a way for the trade to get worse besides getting assigned. Okay. Getting assigned, everyone's always really afraid of it. But if you have, another leg of the option to protect you, it's not the worst thing. It's really just kind of annoying. Now, when we look at my live trading platform, I'm going to show you what this looks like. Now, you come into the options chain and you can see Tesla right here, and you'll say, oh my gosh, well, you told me your max loss was $1,000. Why is it showing that you're down $3,478? If that's the first time you see something like that when you're trading options, it can definitely give you a scare. So, if that ever happens to you and you wake up and you say, well, what happened to my iron condor? I had 4 legs. Now I only have 1, 2, 3 legs. And now I have 200 shares of stock at the 295 strike. This happened because, as I mentioned, remember I had 4 legs, 1, 2, 3, 4. And this 295 strike was deep in the money. And when it came to be Friday, ThinkorSwim exercised this contract and gave me those shares of stock. Now, I've been trading with ThinkorSwim for 10 years now, and I can tell you that over the course of the last 2 years, on Friday, sorry, that's supposed to be a Y. On Fridays, I have been assigned early more times than I have this year. This year, I've been assigned early really more times than I have over the course of the last 5 years. So I don't know what's going on. But that's why it is really important to trade defined risk strategies. Okay. Defined risk strategies mean that if you are selling an option, you have other options that you are buying that can protect you if you get assigned. So, when I'm looking at this, you say, well, what are you going to do with this? Now, the first thing you should always do if you aren't sure, you just send a little message to support and you say, hey, I got assigned on this position. Can you take a look at it for me? Can you explain to me the different ways you can manage this? Now, I'm not really going to go into all the various ways you can manage assignment because that would be another long video. It depends on what the stock price is doing. In this video, I'm just going to show you how to exercise the other option. But essentially, it comes down to this. If you are assigned, you know, you have a few choices. What are your choices? Well, you can just keep the stock. In this case, I don't want 200 shares of Tesla at 295. I have another account where I have my Tesla investments. This is my options trading account. I don't want to keep the stock, so I'm going to sell it. You could, if you keep the stock, you would just, make sure you close out of the rest of your options because you don't want more options to expire in the money. And you also want to take the value out of the ones that have value. So that's something that is important. But when you're looking at all of this, the main thing that I am trying to achieve is, how do I get out of the trade for the same $1,000 risk I had when I put on the trade? Because I don't want to lose more money than what I had originally set as my max loss. So the best way to do that is by taking this 275 put and exercising that put. That's because what I'm doing is I'm saying, hey, you know what? I got put these shares, 200 shares at 295, but I have the right to be able to sell them at 275. So when you do that, it caps your risk. You are not selling these shares at the current price at 263. What you're doing is you're selling these shares at 275 instead. So what you have to do is you have to first of all take away the arrange positions by order, because if you click on this, it's not going to allow you to exercise anything. So you have to go over here, click arrange positions. Let's try instrument. Okay, so now I have all of my positions separated. I don't have a condor that's been broken apart. So what I'm going to do is I'm going to identify my 275 put, and I'm going to click right here, and I'm going to say, all right, I want to exercise. What that's going to do is it's going to use my 275 put to get out of these 200 shares of Tesla. Dun, dun, dun. Let's see. I'm going to go ahead and get a credit of $55,000. Thank you very much. Just making sure I'm doing all of this correctly because you definitely don't want to mess it up. All right, so let's see if I can exercise that. Then at this point, what I will have left is I'm going to have left a 295 call and a 315 call. Now, if you're not sure, if your options are in the money or not, what you do is you just go to your options chain. Okay, thank you very much. You go to your options chain and you can see that, oh, the 295 and the 315 are out of the money. Um, you can tell in ThinkorSwim based off of if they are colored in blue or not. Those are the ones that are going to be in the money. So, seeing that it's Friday and it's an expiration Friday, you definitely want to make sure that you're out of any in the money options or you will get assigned over the weekend. Now, I will note that, getting assigned early, it's kind of a pain, especially if you have a smaller account and you get a margin call. If you get assigned and you get a margin call because your account could not handle, the $55,000 that it was tying up in Tesla, which, hey, it's happened to me. Don't worry. Like, it's not a bad thing. As long as you exercise the other end of your position, you can get out of that margin call, you can close your trade, and it's not that big of a deal other than causing you a little bit of a scare. So if I have to compare, getting assigned early on a Friday versus, for example, forgetting about an in the money position, or maybe you got tied up. I've had, there's one time I was in the TV studio and I got tied up and I couldn't close my trade and, had to phone a friend and see if he could close it for me. Those kind of things will happen. If you get assigned over the weekend, it can be a little bit worse because if your options contract expires, you cannot use it to get out of the other leg. So, if I'm going to be assigned, I would prefer to be assigned early when I still have my options that have not expired that I can use to get out of the trade. So now that we're looking at this trade, you can see it is no longer demonstrating that I have a $3,600 loss on this position. That is because the call credit part of the trade is a max profit. So you take the loss from the put side, the profit from the call side. Um, and at the end of the day, I'm left losing $1,000, which was yesterday, not today. This trade that's still on is showing profitable, so it'll just kind of even itself out a little bit. Now, after all of that, you might say, well, Danielle, was it worth it? Why did you do this? And I'll just tell you, you know what? In options trading, it's all about probabilities and statistics. And with Tesla, this is something that I do every single quarter. Honestly, I will say that this one was 100% user error. When I was looking at Tesla yesterday, probably should have just closed it at the open. It, was hanging right around, what was it, 280, and it rolled a little bit and it was sitting on 270. And I was looking at it and I thought, I'm down a little bit, but it started to bounce. And I should have just taken it there on that hold of support. But throughout the lunchtime hour, I don't know what I was doing. Got distracted doing something else, not watching my trade, and then all of a sudden, it went down too far too fast. So that was a little bit of a user error on my part, but I thought that I would take this opportunity to demonstrate to you what happens when this kind of thing occurs. It's a question that I get all the time, and, I thought I would use today as an example for what you can do when you get assigned early, how these kind of trades play out. But at the end of the day, you should never have a situation where you wake up and the world is over, right? I lost money on the trade. It was within my risk parameters, and we move on and trade another day. If you want to learn more, follow me at Trader Danielle on Twitter. Send me a tweet. Let me know if you enjoyed the video, if you want me to make more, anything like that. Give me some more topics. I would be happy to make some videos for you. And I will look forward to seeing you in the next one.